Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Investment Friday. We haven't had one of these in a couple of weeks, and I'm here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Brad, you're back. What's up, man?
I am finally feeling healthy, finally feeling good as the fall has been progressing, and now we're starting to hit into winter, which, for you and me, we're not in such temperate areas, so that kind of is more meaningful. Whereas a lot of our client base that resides in Arizona, no big deal. They're loving life right now because it's perfect weather down there. So.
Oh my gosh. Yeah. So I'm in Cincinnati. It is the wind chill. So it was 12 degrees this morning with a wind chill down to 5. It was
Beautiful.
very cold. And this past weekend, Saturday, Sunday, Monday, I was in Malibu, California. So where it was like 60 and gorgeous. It was absolutely gorgeous outside. So that was very enjoyable. And now I'm also like sending all of my love and prayers to Malibu because there is a very large fire that is burning. Literally, like the house I was in is in the evacuation zone. So
Yeah,
you never know.
yeah, it's a little sad. We've got some clients that live out that way who have had to evacuate. So, unfortunately, this is becoming a more regular event for those individuals. So, we wish them the best and hope that that all goes well. So,
Yeah, yeah. Hopefully they get that under control because when it is gorgeous over there, like I can totally see like when you're there, like, yeah, why would anyone ever not want to live here with
yeah, so I
wildfire,
uh I took
earthquakes?
my financial risk manager exam at Pepperdine University.
Oh yeah, they
That's
just had
just
to
up.
evacuate.
Yeah. And it is probably one of the most gorgeous campuses overlooking the sea or the ocean. And it is just, right up the hill or right down the hill is the beach. Just fantastic area. But you're right. It's, being in an zone is no fun. So,
Well, beyond that, it is December 12th. We're recording this on December 12th, 3:57 Eastern time, just to put a timestamp on it. This will be released on December 13th, Friday the 13th. We get a Friday the 13th tomorrow. So good luck, everyone.
yeah.
Um, hopefully you're having a good day so far as you're listening to this. And we've had I mean, it's been like normal, quiet, nothing really crazy happening in the markets the last week or so. What's going on there?
Yeah, so I mean, this week, the indices are kind of backing off some of their gains. We had really ever since November 5th, which was the election, the equity markets have really rallied significantly. And so, as with any trend in the equity markets, it's not all one way. So for this week, the markets have kind of been pulling back in a moderate, small amount, which again is to be expected. So really not much has been going on in terms of financial markets. I think geopolitical, lots have been going on, with
Hmm.
the fall of Syria's dictator, Bashar al-Assad. Um, he is now a resident of Moscow, Russia. And we have a coalition of rebel factions in Syria that have taken over the government. Some are sponsored by the US, some are not. Some are Islamists, some are not. So it remains to be seen what's happening. Additionally, during that time, Israel has degraded. It is reported that Israel's IDF, the Israeli Defense Force, has degraded Syria's military capabilities by about 85%. Um, because when you don't know who's going to take over the country, and it could be potentially a couple of groups that have really called for the destruction of Israel, Israel does not want to take the chance. So they have been taking precautions by degrading the military strategic weapons, chemical weapons, stockpiles, and the such, and then also taking over Mount Hebron, which is the largest mountain in that area, where they can keep better watch on the Syria border. So
Mm.
uh, again, from a financial market standpoint, everything is kind of functioning as is, not a big deal, nothing really out of the ordinary. But geopolitically, there's obviously some hotbeds that could take some of our attention in the new year.
Well, speaking of, things that we are watching in the new year as well, before we started recording, we were talking about the boost you just alluded to, that we had after the election, when Trump won, and what some of the things that have been priced in to the market, into that rally that we had, that we now have to wait and see what the implementation looks like. So again, for people, just to be reminded that the stock market tends to rally on the promise of what could be, right? This is a future, like the stock market is a future focused thing. It's saying we think that corporate tax rates are going to fall to 15%. So we're going to price that in. We're going to rally because we think corporations are going to pay less in taxes. So we're going to rally now and then wait and see if it actually happens. And then what happens later? Oh, what if we don't get that cut? That's when the stock market corrects and falls back down, right? So that's we're kind of in that like waiting period. Can you tell us a little more about that?
Yeah, I mean, a lot of promises that were made during the campaigns. Some of which were pro-business, some of which were not pro-business, um, which were made by President-elect Trump and his team. Um, we're going from the promise stage, which is the campaign, to the implementation stage, which happens on January 20th, where he is inaugurated as the president. Um, Implementation is notoriously difficult from a political standpoint. In any government, well, particularly in the United States governmental system, it's difficult to do things from one standpoint. You always have other stakeholders that have opinions, that have power, and potentially some of these could be drawn out in litigation if there's no other recourse. So, it remains to be seen, you know, if the tariffs come on immediately, if the deportations start immediately, if the Department of Government Efficiency starts to ramp up their recommendations to cut costs, it depends on so many things, um, that really it's very, very murky as to what the government's actions could be in the new year. And so right now, I think the equity markets, they've run up based on the promise of lower tax rates, but now they're pausing to say, okay, let's see what else he actually can get implemented very quickly. And then they'll adjust. My guess is the implementation is going to be much slower than President Trump nor or his transition team expects. Um, so we'll see how that all plays out. But we are going to have some volatility because as these little as the stakeholders come about, share their opposing opinions or differing opinions, um, then that could cause some stalemate. Now, that said, I think the tax cut deal for corporations and making permanent the tax cuts of 2016, I think that should be an easy process for President Trump to get done in the first 1 to 3 months of his presidency. So the tax cut, I think, should be the easiest thing to go through.
So the other thing that we've been talking about quite a bit over the last couple of months, we've been talking about interest rates, for years. We always talk about interest rates, right? But interest rates going forward, we had expected and forecasted, earlier this year for continued interest rate cuts through December, through, next spring, through next summer. We were expecting to see about another 2.5% overall. Is that right? And now, given the fact that we have some inflationary policies that we're waiting to hear about, tariffs being one of them, now we're waiting to see if that's going to be true or not. Right. And so what happens with interest rates if we don't see inflation come down?
Yeah. If we don't see inflation come down, if tariffs do go into effect, that is going to significantly push up inflation in the short term. So the 2025 year over year, month over month inflation numbers will be much higher. Um, the Peterson Institute for International Economics estimated it should add 0.8% to inflation over the next year, which is not insignificant. Right now we're at about a 3%, 2.5% to 3% inflation rate. So adding 0.8% onto that's quite significant.
Mhm.
So what does that do to interest rates? Well, we had forecasted at one point in time interest rates coming down to a 3% level. That's probably not going to happen. In fact, we'll probably get an interest rate cut this month and then pause. Okay. And I think the Federal Reserve is going to pause to see that implementation stage. What kind of tariffs are actually put on? Is that going to come about? Do we need to worry about those impact on inflation, or does he change course and only hit certain countries with certain types of tariffs, and other countries he's already made deals where he it's not going to be a blanket tariff? We don't know that yet. And so I think the Federal Reserve is going to be very cautious in doing that. My best guess is right now we may not get any more interest rate decreases in 2025, or we may get one. Um, excuse me.
Bless you.
Um, Again, it's fall and winter here in Utah, so lots of flu and stuff going around. So,
At least we're
um,
on Zoom. You didn't sneeze on me.
yeah, exactly. Well, so I think I think the low point in the interest rate cycle is going to be much, much higher than people were anticipating even 3 to 6 months ago. Now, that's not necessarily a bad thing. All right. As we were discussing prior to our recording, you know, prior to 2001, we had much higher interest rates, and the Federal Reserve played in, the 4 to 7% range, generally speaking, and that those were really, really good times. So just because interest rates are higher than, the 2001 through 2023 era, that's okay. Higher interest rates are not necessarily bad, because it means, one, that inflation is somewhat decent, okay? And inflation at the end of the day is pricing power for corporations for their goods and services, okay? That helps maintain their earnings. It helps them grow their earnings to a certain extent. Additionally, that should flow through to wage increases, um, and better use of technology. Okay. So there should be some things addressing that here in the next year or so, from a legislative standpoint as well.
So when we're looking at interest rates, when we're looking at inflation, one of the main things um, that I feel like a lot of people were wanting or thinking might happen is that prices would go down on goods and services. And the reality is that we have rarely in the United States had actual deflation. It does not happen very often. We had stagflation in the 70s, right? We had deflation in the Great Depression era, and I don't think we even really had it in 2008, 2009 Great Recession.
No,
Um,
we did a little bit, but not it wasn't even significant enough to talk about it too much. But I want to reiterate to our listeners and our viewers, deflation is a terrible thing. It's far worse than inflation. It's far, far worse. It means that your income and your asset values are going down, which means what? The debt that you have supporting those assets is actually staying the same. So you're levered to the downside on your net worth. It's not a good situation. The only time economies go through deflation is when everything is imploding, everything is falling apart. The consumer won't spend because they're afraid. So it's a very, going back to the Great Depression, that significant devaluation in all assets, real estate, commodities, stocks, obviously, which is the big crashes. It's a terrible condition under which to live. Inflation is okay. Larger inflation, not okay. But the fact of the matter is, in certain commodities like agricultural products, gasoline that we buy a lot, electricity still is still very, very, very much generated based on the productive capability and the demand for those commodities. So, eggs for whatever reason have become this
Poster
uh
child.
poster child, this barometer for inflation. Um, we had a big culling of the hens, the egg laying hen herd. Okay, not herd, but flock.
Block. There we go.
Yeah, they had to go through and cull a lot of those birds because there was a disease going through them. Well, that also, because the supply went down, demand remained the same, prices went up. And they went up significantly, as we all know. We've all experienced at the grocery store. We all saw it. We all heard about it from President Trump. So it became that barometer of inflation. Um, Certain commodities like that will recover, okay, in terms of supply. And as they do, their supply comes up relative to the demand, those prices will fall.
Hmm.
But in general, to have a general state of deflation where the average consumer's cost of goods and services drops is a very, very poor economic situation. It's one that I hope we never have to live through.
Mm. Yeah. So there's, while we've talked about this on the podcast, we did go through that period of high inflation over the last several years. Um, Prices are not going to come back down to 2019 prices. Like that's just not happening. And we know it can feel frustrating to go to the grocery store and be like, this is what things cost now. And to know that, yeah, that's for the most part, for most things, yes, that's what things cost now. And they're not going to come down from that inflated level. And what we can do from this point, the lever that we can pull as individual consumers is income, right? That's what I talk about with my clients as well. Actually, since I work with a lot of entrepreneurs and business owners, it's well, let's look at the income levers because that's the one that we can exert the most influence over. And for the most part, that has been true.
Yeah, and I mean, as a worker, to have a general state of inflation, it generally means people are getting laid off and wage growth is negative, meaning you get laid off, the next job you get is going to pay less than the one you just left.
State
So
of deflation, you mean?
yeah, in deflation.
In
So
deflation, yeah.
that's a problem, right? Now, what is happening now is we had a big spike in inflation. Then inflation has been dropping, still positive, so it's still inflating, but just at a much lower rate, much more manageable. And we're starting to see real disposable incomes in the US workforce starting to catch up, starting to make headway on, again, catching up to what the 2019, 2020 levels were, where pre-pandemic. So over time, real disposable income will catch up and will compensate for that higher level of inflation, of that cost of goods and services.
All right. Well, we'll keep watching that and telling you all about it as it pans out or doesn't or whatever we start seeing over the next, couple months really, right? We'll start to see. The one prediction you did have for 2025 is that it's going to be volatile.
Yeah, it's kind of a wimpy forecast, but you know, I think by the end of 2025, as we sit here a year from now, I think the equity markets are going to do fine. I don't think they're going to be, I think we're going to be in the 5 to 10% range in terms of returns for those large cap indices that we all like to hear about and the media likes to tell us about every day. The S&P 500, 5 to 10% return is not a bad deal based on a 20 to 25% prior year return. So I do think we're going to have a decent, okay rate of return, but um, it's going to be bumpy along the way as implementation becomes an issue politically. We have some geopolitical hotspots that could really grow into real problems over the next 12 months. And I think the equity market has to pause for a little bit to assimilate where are the next levers of growth going to come from. My guess is part of it's going to still be the artificial intelligence or AI boom, both in infrastructure and application development. I think we're going to see more uses of AI, more use cases in how we can use AI to help lower our average cost of doing business and therefore growing earnings. But again, there's a couple of other trends as well outside of artificial intelligence in terms of the drug manufacturers, in terms of food production, in terms of communication, in terms of personal security. There are a couple of trends that should do really, really well next year, but it's not going to be without its bumps in the road.
Will you have, I didn't ask you this question before. Will you have a like a year look back and a year what do you call that one?
Forecast.
A year okay.
It's a year in review. It's a year in review and a forecast for the next year.
Okay, that's what I was getting at. Yeah.
Yeah.
So will you have that ready within the next couple weeks here? When can people start to look for that?
Yeah, so probably by the early January, you'll start to see that floating out in your email boxes. I typically don't do it in December, as I want to take the time to sit and think about what the trends are really going to be. Um, Particularly, I want to get more detail on some of the political stances and policies that President Trump is actually going to put forth. I want to see more detail on those. But again, best case scenario is yields and interest rates are much higher, or they're higher than we thought they would be, moderately lower than they are today, um, with the equity market being up a little bit more than it is today, um, with commodities, depending on how China does, commodities is going to be very, very dependent on China's marginal growth, which
Mm.
the last year has not been good.
Well, when that is out, we will let you know. And if you're a client of Juncture Wealth Strategies or a client of mine, you will get that automatically anyway. But if anyone else wants it, you know where to ask, where to send an email, and we'll tell you at the end. But for today, again, it's December 12th today, as we record this, and the end of the year is typically a time where a lot of other firms talk about tax loss harvesting. And so we wanted to talk about that a little bit today, and talk about how other places do it and how we do it differently at Juncture. So I will say 4, 5. Oh my God. It was 2020. So it was 4 years ago at this point, not 5 years ago, 4 years ago, when I was talking with Brad, thinking about joining Juncture as an advisor. Um, I had a lot of questions about how they ran investments, about um, how they, did loss harvesting. How do we, how do you do things? And you, to your credit, took every single question that I had and actually answered it fully, which I super appreciated. And it was the thing that was like, okay, I feel safe landing here. I feel safe with the process that you go through to vet investments, the more active management that we use, and the harvesting throughout the year when it makes sense for different clients. So, where I was at before, we almost exclusively used mutual funds. And so with mutual funds, the way that they are created, it's like you have a basket and think of it as literally here's your basket of stocks. And they're different kinds of stocks. If you have a large cap growth mutual fund, there will be, I don't know, 25 to 50 or more large cap stocks, growth stocks in that basket. And you get a little portion of all of those. But that mutual fund has to, as it receives capital gains throughout the year, per their mandate, they have to pay out capital gains to their investors. And so that usually happens in November, late November, early December is usually when we start to know what those numbers are going to look like. So every year, the place I was at before, we would have to like check. We would have to look at all the different mutual fund companies, check all of our mutual funds and see who might be paying out big capital gains. So, Brad, maybe I don't know if we have an example that we can even use for this year, but like this year, there has been a lot of gain, especially in that large cap growth area. So, let's say you have a fund that's gained 20 or 25% in one year, they have to pay that gain out to their investors. The rub, though, why it doesn't feel good coming out of a mutual fund and it doesn't feel like you gained anything. Let's say that mutual fund is trading at $100 per share, and they are going to give out a 5% capital gain distribution to all of their investors. It's trading at $100 per share on December 12th. On December 13th, they're going to pay out a 5% capital gain to all their investors. In order for that math to work, the fund is now worth $95 per share. So you got 5%, you got that $5 per share as a capital gain distribution. That is a taxable distribution to you. You have to pay tax on that distribution. But now your mutual fund is worth $95 per share. So the value is the same overall. You just have to pay taxes on something you didn't sell. And so that's called a capital gain distribution that happens with mutual funds because it's required as part of their mandate. And so it kind of sucks. It sucks when you're like, I didn't, I don't have more money than I had yesterday, but now I have, a capital gain distribution that I have to pay taxes on. And so with mutual funds, again, that's just how they work. What did you want to add to that?
Yeah, I mean, Morningstar did an analysis of a lot, and if you have a mutual fund that has previously done very, very well, but over the past year or two hasn't done as well, and they've started to have outflows, that is a condition where, or that's a setup where you might get larger than normal capital distributions
Mm,
that year. For example, they compile a list of 50 of the top mutual funds that are going to pay out capital gains in excess of 10 to 50% of their underlying NAV, which you're taxed on in that year. So to your example, if you would have bought these funds in, let's say, August of this year, you would have gone up a little bit, but all of a sudden in December of this year, you're going to get a big tax bill on a gain that you never saw. And the reason that is, and I think a lot of investors think that's very, very unfair, and it is to an investor who just invests in the short term in those funds. But the reason that is because a mutual fund is considered an investment company. It's its own individual company. So you have to look at it as an operational as an operating company, not just as a manager of the underlying assets. And so I know Morningstar and a couple of the other data analytics that we use whenever we're looking at a mutual fund, one of the criteria we look at is how much is the embedded capital gain? Is it 5% of the underlying NAV? If it, is it 70% of the NAV? Some of the older, more well-established mutual funds that have been around for 60, 70 years, you got to be very careful on those because some of those have very, very high embedded capital gains. You just want to make sure that you're aware of it and that you're not holding that in a taxable account if you can do that.
Yeah. And so the inability to have that kind of, the way I'm going to put it is like complete control over the taxation of your investments is part of the frustration with mutual funds. And for people who that's just how their investment advisors work, they don't work any other way, that, there's this like throw your hands up kind of thing. Like, well, that's just how it works, and we deal with it as best we can. So we'll talk about tax loss harvesting in these other areas where there are losses so that we can offset some of those gains that are going to happen. It's just this ethic ethos really of that's just how it is and we deal with it. What I loved coming to Juncture was that like it was like you take the blindfold off. You're like, no, you don't have to do that at all. Like that doesn't have to be the process in any way. One, because ETFs exist. And so we'll talk about those in a second. And then individual stock positions do not have capital gain distributions. That doesn't happen, right? There are dividends. Sometimes we might have interest in dividends that we have to pay current taxes on. But other than that, you only realize a gain when you make the sale. When you choose to sell something, you'll have the gain or the loss with individual stocks or individual bonds for that case, since we also use individual bonds in a lot of accounts. And then ETFs or exchange traded funds. So the difference here, an exchange traded fund is also a basket, right? So it's similar to a mutual fund. It's also a basket of a lot of different individual stocks. If you have a large cap growth ETF, it might have the exact same investments as that large cap growth mutual fund. So the basket looks very similar, but the exchange traded fund has a couple of other details that I'll let you illuminate, Brad, in addition to the fact that it trades like a stock and it doesn't have any capital gain distribution. So you only realize a gain or a loss when you decide to sell. So what's the other difference?
Yeah, so they could technically pay out capital gains, but generally they're much, much lower. And the reason why is because exchange traded funds have a unique feature that it is not necessarily available in open-ended mutual funds. And that is if I was a large investor, institutional, let's say I had $1 billion in this XYZ mutual fund, okay, and I took $1 billion out of the mutual fund. Well, what happens is that mutual fund has to tell the money manager, sell $1 billion worth of securities so they can give it to me, my cash, okay, because I've redeemed it. So as they go in, they sell $1 billion across the portfolio. And in that portfolio are holdings they've had for quite some time. And that generates gains for all of the other shareholders of that mutual fund. An exchange traded fund is a little different in the sense that if I have $1 billion in that exchange traded fund, what I do is I call up the sponsor of the ETF, whether it's BlackRock or Vanguard or State Street or whoever owns that ETF or sponsors that ETF. I call them up and say, hey, I'm going to take out $1 billion today. Can you help me with that? And they say, absolutely. So what they do is they transfer $1 billion in securities out of the ETF and into my account. Okay. Now, I own all of the representative portfolio, all the securities of the underlying portfolio of the ETF still. So I get all of the tax basis in this new account. What I do is I, as the money manager, sells all those securities. I take that gain out, not not the other investors in that exchange traded fund. So that unique feature of redeeming units directly through that mechanism really keeps exchange traded funds taxability it keeps their taxability costs to a minimum for all shareholders.
So when we are looking at portfolios, when we are talking about tax loss harvesting, tell the audience, I know, but tell me like I don't know,
Okay.
um, how we do tax loss harvesting at Juncture.
Yeah. So tax loss harvesting for us is a throughout the year process. It doesn't happen just at the end of the year, in December, November, December, where we try to minimize those gains. We do it throughout our year, our process. When we have certain criteria that are set up that when a security violates those that criteria, our system flags it, says, "Hey, this XYZ stock in so and so's account is showing a tax loss of this amount." We'll go in, we can sell that security and buy one with a similar economic exposure, not exact, but similar. And so we maintain the economic investment of the client, but yet capturing that tax loss. And we do that throughout the entire year. So oftentimes when things are a little volatile earlier in the year, later in the year, we don't have as much capital gain as a manager otherwise would.
Yeah, so I mean, I actually had this question from a client a couple of years ago because another financial advisor was, saying, "Well, do they do tax loss harvesting?" Almost like a, gotcha moment, like, "Oh, I don't know if they know what that is." And I was like, "We actually do it all the time. We have a process to balance and make sure, that we are keeping people within their capital gain tolerance throughout the whole year. We put goals on it, like if we don't want to realize more than 5% capital gain through a whole year, like that's what we'll do rather than just be at the mercy of whatever's happening with the mutual fund payouts at the end of the year. So there's a lot more thoughtful tax planning that can go into it when we are proactive and when we use instruments like individual stocks and ETFs, individual bonds, that we can control more of that taxation. Did I get it right?
Yeah, perfect. Perfect.
Good. So the invitation here is to one, if you have an advisor and you've never asked them about this process, how they do it, it's a very important thing to understand. And then second, if you've been doing it yourself and you're like, oh, I definitely need help, I didn't know about that, come ask us questions. We can absolutely talk about it. We'd love to look at the portfolio, see what your taxation has been like, all of those things. Like we are up for the conversation. So with that in mind, since it's the end of the year, there's maybe a few things we could do at this point, maybe not though. But there's always planning and plenty of time to plan for 2025. So with that, we will wrap it up for today. Thank you, Brad, as always, for being here. If anyone has questions, you can email me at Hannah, Hannah, at expansiveceo.com with any podcast questions you'd like for us to answer here. And Brad, how can people get a hold of you?
You can get a hold of me at bhaines, Bhaines at juncturewealth.com, or you can give our office a call at 480 2, man, 480 2. Oh man, this isn't good. I can't even remember the phone number. That's not good. Hold on just one second. I will look it up.
Brain fart. It's okay. It happens to the best of us.
It does, but still, it's like, oh my goodness. I never call us, so it's tough to find that sometimes.
I do that with my business number all the time.
Yeah. So it's 480-253-4100. So
There
that's
you
our
go.
number. So give us a call at the office, and Kristen or Wanda will be able to put you through to me.
Well, thank you so much, Brad. And if hopefully we'll get to talk one more time this year before the end of the year, but if not, Merry Christmas.
Merry Christmas to you, but hopefully we'll be able to speak before the end of the year.
I hope so. Well, as always, have an awesome weekend. Happy Friday to everyone. And again, it's Friday the 13th. Be safe out there. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.